Jack, first of all, why are these stocks doing, in some cases, worse than the overall market today when the one thing people say could be a help here is housing demand?
Yeah, I think part of the problem today is the issue of sentiment. Most people don't go out and buy a house because rates pulled back. Most people, first-time buyers aren't sitting in their apartment saying, "Okay, now the mortgage rates are at 320, 325. Let's go buy a house." I think what people are pricing in is a fall off of confidence in the economy overall, potentially leading to some job loss at the corporate level. But underlying fundamentals for housing remain very strong.
Right. Is that fear rational to you? In other words, home builders have been a pretty strong performer. Would you go so far as to say to people, look, this sector can hang in there even if the economy slows?
Yeah, we would. In fact, we upgraded Pulte Group last week from neutral to positive. Think about the fundamentals of housing. You've got a supply imbalance. We've probably underbuilt just roofs, 500,000 to a million, depending on which numbers you use over the last 7 or 8 years. You've got the biggest demographic wave since the boomers coming into their peak home buying years over the next 6 to 8 years. And you've got record low interest rates. So, the fundamentals here are pretty solid. On top of that, you don't have a lot of supply chain issues, right? A lot of these, you don't have a lot of stuff being built or shipped in from China. It's a domestic play here in the U.S. So we like the fundamentals still. We've been in a lot of markets, even through mid last week. We're hearing any signs of virus-related demand issues or anything of that nature.
So you're comfortable buying a lot of these stocks right now?
Yes, I think if you look at it over a 3 to 6 month period, I think we're going to look back and feel like this was an overdone sell-off in the group.
3 to 6 months, let alone 3 to 6 years, right?
Oh yeah. I mean, you can't deny the fundamentals, and I think what people are looking at is if we're going into a recession, the knee-jerk reaction is, oh my gosh, the next recession is going to be like the last one. The housing, fundamentals in housing couldn't be more different than they were in, say, 07, 08, 09. It's a dramatically different environment. I think people have to step back and really look at where the drivers are today versus where they were. Mortgage credit is responsible. It's rational. People are, there's job growth, there's wage inflation. And again, we are undersupplied. I mean, the existing market is running about 3 months of supply. A normal market's 6. I think some of the builders this year have helped fill that void. And where you're seeing most of the strength is on that entry-level segment, those first-time buyers. The public builders are uniquely positioned to serve that demographic, more so than the existing market.
Jack, as we see KB the worst hit today, Lennar kind of secondarily so, are there any of these builders that have particular exposure to Texas, to the oil patch, to some parts of the country that may see a slowing because of the plunge in crude?
Sure, and we had a note on that just this morning. KB has about 11% of company deliveries last year from Houston, so they're one of the larger names in my coverage universe. I think that's partly what's driving the relative underperformance of the group. But you go back to 2014-15, we had a similar collapse in oil prices in the back half of 14. In 15, new home sales in Houston were only down 3%. So I think there's more resiliency in the Houston economy, but for today in the short term, I think people are singling out some of the builders like KB relative to others because of their, outsized, if you will, exposure to Houston. Other builders are in the 3 to 6% range of their business.